So, thank you, Prem, for your kind introduction. Good evening, everybody. What I'm going to cover in the next few minutes is about international investing, and I'm going to talk about a strategy that has worked very well for me when it comes to international investing. Before we get into international investing, I think the key question that we need to address is why should you, as an Indian investor, leave the comfort of the Indian equity markets, especially when everybody is talking about India as being one of the large economies of the world, which is growing at a very fast pace for the foreseeable future. So the key reason, why I feel that you should look at some allocation into the international equity markets is because of diversification. As the Nobel Prize laureate Harry Markowitz, who is the father of modern portfolio theory, wisely said, diversification is the only free lunch in investing. Basically, it means do not put all your eggs in one basket. Because if you've seen history, we know that however good the prospects for a market be, no market moves in a straight line. If you take, for example, the US market, where everybody is very keen and very bullish on in general, if you see between 2010 and now, the S&P 500 has compounded at nearly 15% in US dollar terms. But if you go back to the period from 2000 to 2009, actually during those 10 years, the S&P 500 returned minus 1% on an annual basis. So basically, if you had invested in the beginning of 2000, you would have actually lost money if you have held money in the S&P 500 till 2009. So the key takeaway is you should not put all your eggs in one basket. If you look at the Indian market, for example, if you look at the chart on your left-hand side, it shows how MSCI India has performed in relation to the global markets as represented by MSCI All Country World Index. Over the 10-year period, on an annualized basis, actually MSCI India has underperformed at over 4% per annum. And this underperformance, if you look at the chart on your right-hand side, has come with a much higher volatility. Actually, the volatility of returns in India is about 8% higher than the volatility of returns in the global markets. So not only has the Indian market underperformed, but the underperformance has actually come with a higher volatility. The other key reason why one should consider investing in international markets is to gain access to cutting-edge technology stocks. If you look at the table on your left-hand side, these are the top 10 weights in the Nifty index. And as you can see, out of the 10, 6 are in the financial sector, and only 2 is in the information sector and information technology sector. And even these two, Infosys and TCS, are actually software services players, not really, cutting edge technology product players. Whereas if you look at, the table on your right-hand side, you can see in the S&P 500 list, 7 out of the top 10 weights are actually cutting edge technology product companies. So this is another reason why one should consider allocating some part of your portfolio to international equities. So if you come to international equities, there are a number of strategies you can adopt. So now I'm going to spend the next few minutes talking about a strategy that has worked well for me in my career, which is investing in leading global brand companies. So this is nothing but, you would have heard about the compounding, investing in compounders. And in my experience, the leading global brands are nothing but compounders over the long term. What is a brand? A brand is an intangible that distinguishes two similar products. It is something which is viewed by the customer, which creates brand loyalty. A classical example is Apple. If you look at the Apple, when it launches a new product, you can see the diehard loyalists of Apple queuing up nights on end before the launch just to be the first in the queue to get their hands on a new product. And that is what a leading brand creates, undying brand loyalty. From a marketing point of view, obviously, brand loyalty is important. But why is it important from an investment point of view? A few things. A strong brand creates a competitive advantage. And this in turn leads to superior earnings growth, which in turn leads to premium sustainable valuation. Let us look at a few examples. So these are 5 leading global brands. And you can see that I've taken the period between 2015 and 2020. You can see that, despite 2020 being a washout because of COVID, sales have grown consistently. So has, the net profit for these companies. And as a result, shareholders have rewarded them handsomely. If you look at all the returns of these 5 companies are well above what MSCI Equity has returned over these 5 years. So that is the importance of having a good brand and investing in a leading brand. So the real way they achieve this is because they develop a competitive moat, which enables them to gain brand loyalty. And this enables them to actually diversify into multiple business categories, as well as get into multiple geographies and sustain pricing power across economic cycles. And all this results in durable cash flows and a very strong balance sheet. Let us look at some of these examples. To take Apple, actually, if you go back to the 90s and early 2000s, Apple was basically a Macintosh, the computer brand driven company. And if you look at what Apple is now, Mac is only about 10% of their revenues. You can see that the revenue base is well diversified because they were able to get into various products, which they were able to do so because of their strong brand loyalty. In 2001, Apple was able to launch the iPod, followed by the iPhone in 2007, the iPad in 2010, and the iWatch in 2015. So in all these categories, actually, they were not the first to get into the category, nor were they even the one which had the most technologically advanced product. But because of their strong brand loyalty, they were able to make a huge impact in these products. For example, if you look at the smartphone market, Apple has about 30% of the global smartphone revenues, but nearly 60% of the total profits in the smartphone market globally. The other characteristic of good, strong brands is they are able to generate revenues across geographies. If you look at BMW, the marquee German brand, if you look at their revenue base, only 44% comes from Europe. The balance, 56% comes from all around the world. And similarly, if you look at LVMH, which is a leading global luxury brand, it's a French company, which is about 200 years old now. Only 24% of their revenues come from Europe. The balance, overwhelming 76%, comes from the rest of the world. So that is the real strength of a strong brand. Their loyalties are not limited to their country of origin. They are able to generate revenues from multiple geographies. And because of their strong competitive position, Normally, the strong brands generate cash year in, year out. So these are some of the leading global brands. You can see the strong cash reserves that they have. I'll just take one example because of shortage of time. I'll talk about Alphabet, which is the holding company of Google. They have a cash reserve of almost $110 billion, which is about 20% of India's foreign exchange reserves. So that is the strength of a strong brand. They're able to generate, durable cash flows, as we have seen. And they're able to use this cash in a strategic manner by making acquisitions. If you look at Facebook, the number of acquisitions it has done. Instagram is an interesting one. In 2012, they bought Instagram for $1 billion when it had just 13 employees. Now, of course, Instagram has got over 1 billion users and generates $20 billion annually in revenue. Similarly, if you look at WhatsApp, they paid a whopping $19 billion in 2014 for WhatsApp, when WhatsApp was loss-making actually, and had only 500 million users. Now WhatsApp has over 2 billion users. The same if you look at LVMH, they used the COVID crisis to acquire Tiffany, which is a global luxury jeweler at a good price. And if you look at the global brewing company, Anheuser-Busch, they did an acquisition of SABMiller, the number one and number two in the brewing business globally, and they were able to create a truly global brewer. So that is one of the key advantages of having cash with you. You can make strategic acquisitions at the right time. The other key thing is that all these companies, because of their strong cash flows, typically buy back 3-4% of their market cap every year. And as you know, share buybacks are a good way of ensuring that shareholder value is maintained, particularly in weak times. Now, this concept of brands, does not work only in international markets. It has worked very well in India too. I mean, if you look at some of the leading brands, you listed, 6 brands here, you can see how they have performed between 2015 and 2020. Again, 2020 being a washout year because of COVID. You can see that growth has been very strong and consistent. The profits growth has also been very strong. And as a result, all these shares have been rewarded very well by the market, significantly outperforming the Nifty index. So this is the crux of the strategy. Basically invest in leading brands, and you are more likely to do well over the long term. The difference between the Indian brands and the global brands is the valuation. If you compare the P multiple of BMW to Maruti, actually BMW is trading at 1/5 the valuation of Maruti. And similarly, if you look at LVMH versus Titan, LVMH, the global luxury leader, is trading at half of Titan's valuation. Now that time is over, I want to wrap up the presentation with a simple lesson which I want to leave with you, which I have learned in my investment career. Basically, in order to make money, you need not look at complex investing strategies. What you can do is figure out a simple strategy, like I have done in investing in global brands or leading global brands. That is the strategy which is very simple to actually think about and execute, and which can yield you very good returns over the medium and long term. Thank you.
Yeah, hi Anish, that was a very interesting presentation. You make out such a strong case for these global brands. How do I, as an Indian, how do I participate in such opportunities?
Sorry, Prem, I lost you in the middle.
Okay. Now, as an Indian, how can we participate in these global opportunities?
Either you can invest in one of the international funds which are offered by the various mutual funds, or now I am told that the broking houses now enable you to invest in overseas equities too. And even
Okay.
Gift City, what I read is they are setting up some of these shares listed on the Gift City exchange. So these are some of the ways that people can participate in some of.
Sure. Okay. Okay. Thank you, Anish, for taking our time and being with us this evening.